Taxes are an unavoidable part of running a business. Whether it's income tax, payroll tax, or unemployment tax, companies must stay compliant with federal and state regulations to avoid costly penalties. Employers play an important role in withholding and submitting taxes, from federal income tax to Social Security and Medicare deductions. But it doesn't stop there. Businesses are also responsible for filing year-end tax forms like the W-2 and ensuring that payroll records match tax filings. And when they don't, employees may end up receiving corrected forms, and businesses could face tax notices demanding adjustments. In this video, we'll break down employer-paid and employee-paid obligations and explore what payroll accountants must do to keep everything in check. Let's take a closer look at employer-paid and employee-paid obligations and clarify who's responsible for each portion. Employer-paid payroll taxes are statutory deductions mandated by law. The table here outlines which party is responsible for each deduction. In some cases, both the employer and the employee contribute, such as for Social Security, Medicare taxes, local occupational taxes, if applicable, and 401k contributions. However, income taxes such as federal, state, and local income taxes, along with other voluntary deductions, are paid solely by the employee. On the other hand, FUTA, SUTA, with certain exceptions, and workers' compensation insurance are paid exclusively by the employer. Regardless of who holds the responsibility for paying the taxes and deductions, once a company hires employees and issues paychecks, the employer is required to reconcile the employee's tax withholdings with tax payments on quarterly and annual forms. Even after an employee's termination, the employer's tax obligation often persists depending on when the employee left and the specifics of the termination. For instance, if an employee resigns, the employer must pay any final amounts owed, file the necessary quarterly reports, and issue a W-2 at year-end. If stock options or restricted stock were granted to the employee, the reporting responsibilities may continue for years after the employee has left the company. So how does it all work? Let's start by examining the FICA taxes, specifically the responsibilities of both the employee and the employer. As we mentioned earlier, both the employer and employee share the responsibilities for FICA taxes. The employer matches the amount withheld from the employee's paycheck for these taxes. The employee has 6.2% withheld for Social Security and 1.45% for Medicare tax. In addition to the amounts withheld from the employee's pay, the employer is required to pay an equal amount. Social Security is withheld up to the maximum wage limit of $168,600 for 2024 and $176,100 for 2025. There's no maximum wage limit for Medicare taxes. However, when it comes to the Medicare surcharge, only the employee is responsible for paying this if their earnings exceed the maximum wage limit. For 2024, the Medicare surtax thresholds impact single filers with an adjusted gross income above $200,000 and married couples filing jointly with an adjusted gross income exceeding $250,000. Here's an example of calculating the total FICA tax liability. In this example, Russo works as an hourly worker who earns an annual salary of $36,000 and is paid biweekly. Her gross pay is $1,384.62 per pay period, $36,000 per year divided by 26 pay periods. Russo's share of the Social Security tax is $1,384.62 times 6.2%, or $85.85. Her employer's share of the Social Security tax is the same, $85.85, for a total Social Security tax liability of $171.70. Russo's share of the Medicare tax is $1,384.62 times 1.45% or $20.08. Her employer's share of the Medicare tax is the same, $20.08, for a total Medicare tax liability of $40.16, which brings the total FICA responsibility from Russo's pay this period to $211.86. Employers are also responsible for unemployment taxes, which includes FUTA, Federal Unemployment Tax Act, and SUTA, State Unemployment Tax Act. FUTA covers the administrative cost of the unemployment program, while SUTA funds the actual unemployment benefits paid to employees who are out of work. Federal unemployment taxes apply only to the first $7,000 of an employee's wage. Once an employee earns $7,000, the tax no longer applies for the rest of the year. It's crucial to track each employee's year-to-date earnings to ensure the correct amount of FUTA is remitted. While many states use the same $7,000 wage thresholds, several states have set higher thresholds. The FUTA tax rate is 6%, but employers may receive a 5.4% reduction if they make all SUTA deposits in full and on time, and if they're not in a credit reduction state. A credit reduction occurs when a state borrows funds from the federal government to meet its unemployment insurance obligation. It's important to note that the SUTA tax rate varies among companies depending on factors like employee turnover and layoffs. Payroll accounts typically handle reviewing the unemployment forms sent by the state unemployment tax agency after a former employee files for unemployment benefits. Here's an example. Snowborn Inc., a company based in Great Falls, Montana, employs 178 workers, all of whom earn more than $7,000. By the end of the year, only 145 employees remained with the company. How do we calculate this tax liability? Since all employees earn more than the $7,000 threshold, we don't need to consider their individual earnings. Only the first $7,000 is subject to unemployment taxes. The number of employees who left the company doesn't matter. Taxes apply to all employees. So to calculate the FUTA taxes, we would multiply 178 employees times $7,000 times 0.6%, which is 6% FUTA tax rate, minus the 5.4 state reduction, equals a total FUTA tax of $7,476. What happens if some employees earn less than $7,000? In that case, we will multiply the number of employees who earn more than $7,000 by $7,000, and then add the wages of those employees who earned less than $7,000. State unemployment taxes, or SUTA, are based on factors like employee retention and turnover. Employers with low turnover rates typically face a lower SUTA rate compared to employers with higher turnover. The standard guidelines for SUTA is 5.4%, but the rate can be higher or lower depending on the employer. An employer's SUTA tax rate is influenced by both state unemployment rates and the company's experience rating. So, for example, the SUTA rate for company A may differ from that of company B. A construction company, due to the seasonal nature and higher risks in the industries, may have a higher unemployment rate, like, for instance, 4.54%, whereas a similar sized company in the professional services industry might have a lower rate, for instance, 3.28%. Each year, states sent letters to companies with their individually determined SUTA rate for the upcoming year. In California, the SUTA wage base is $7,000 with minimum and maximum rates ranging from 1.5% to 6.2%. To minimize SUTA taxes, employers should understand how the rating system works and regularly review their SUTA account. It's also important for employers to carefully select new employees to avoid high turnover. When an employee leaves or is terminated, employers should review the separation documentation and contest unemployment claims if applicable. Ensuring that SUTA tax is paid on time is also crucial. These are just a few strategies. Your textbook offers additional tips for managing SUTA taxes. In addition to SUTA, employers are also responsible for workers' compensation insurance. While it isn't considered a tax, states enforce workers' compensation laws, and federal employees are protected under the Federal Employees Compensation Act. Workers' compensation is an insurance policy maintained by the employer, and premiums vary based on the employee's job classification and the level of risk associated with the work.